Hello, everyone. Thank you for coming today. This is Chris Capre of SecondSkySports.com. Welcome to the webinar, Price Action Trading on Any Time Frame. So I got a couple exciting ones here for you. And I'm going to be talking about spot gold, a couple trades I did on an intraday basis. I want to talk about a sterling dollar trade I made on the 4-hour chart. So that's what we're going to be covering today. And I also want to, as you know, the way I tend to start these webinars is I tend to start off with some sort of story or experience or trading situation. And I'm going to start off with something that I had done recently. It was actually an experience I had from trading, which was I was in a short position. In fact, I should probably show you that chart. So let me change here for a second. Okay, so it was going into Friday, and Aussie has been kind of cycling between relative floor and a ceiling, and I have a system that will play these cycle changes. And so the system it wasn't actually a price action system, but I want to talk about something that I had gone through during this trade that is something that you may encounter. And so, I thought it was a very valuable lesson. So, it's kind of posting these regular floor and ceiling. The last two are pretty darn close to each other, give or take a couple pips off. And other than this spike low here, we're talking relatively the same floor right around here. So produce another swing high. And then I want to zoom into here. So it was Friday, and I had a couple potential setups on a system I have called the Volatility Striker. And so I was watching, I'd watched the price action prior, and it made the break there. And then it formed a doji after, which is generally not the most inspiring candle to see after a breakout. If the breakout is really strong from a price action perspective, then the following candle ideally is another candle in the same direction. So it should have been another bullish candle, and it wasn't. It was a doji type candle. And it retested the same area, and then it started to break back below it, suggesting, hey, this is being treated as resistance. Well, pulls back in kind of a corrective fashion. It takes 7 hours of selling to come back and retreat or take back what it gained from 1 hour of buying. So it's impulsive versus corrective, touches off the 20 MA, and encounters some buyers. But then this is what's interesting. After kind of peaking above this level, it closes here. And then the next candle, I'm going to zoom into that as well. It peaks above it and then closes right at this level. So there's something about this 107.76 that keeps being a sticking point. And it was interesting because my system was starting to get a turnover saying, hey, we're probably going to get a turnover in this, price action here, so watch for it. And it was perfectly aligned with the whole price action environment. It was cycling between the floor and ceiling at 106.50 all the way to 107.76, and it had already done this, several times. 1, 2, 3, 4, 5. This is the cycle we're getting into, but I'd already done it 5 times. So it wasn't surprising to me that I was getting another turnover of the signal. Now, what I want to point out is, okay, we had the double rejection here, open and close at the same area. And I said, okay, since this was the pullback right here, this little pullback from the strong buy up, pulled back, created a breakout, and then from there it said, okay, buy off the 20 MA, rejects off here and starts to break down. My system was giving a trigger around this area, right around the 107.50, and I said, you know what? Let's wait until it clears 107.43. So I'm going to look for a 107.42 entry. And I said, okay, once I get my 107.42 entry, then I'm going to look for entering there, going a short to end the week. In terms of price action, I'm not going to necessarily expect it to end the week to maybe drop 80 pips. Especially with volatility coming out of the market with players closing positions before the weekend. So I want to look for something around here, 106.93, kind of, a sticky point here briefly. Gives me some nice opportunity to get into this play. Well, let's start to go to this candle by candle here, and I want to talk about the experience of what happened to me here. So here I get my entry, and the stop based on the system was nicely above, just a handful of pips above the high of this candle, basically, right here. So I said, okay, I'm in at 42. I have about a 65 exit roughly, 23 pip stop, so I need a minimum 46 pip target. And that would mean basically putting me right at 106.96, which is fine because I wanted to be getting out of route there anyways. Here's where I made a mistake. And so I want to kind of talk about this because this is a common mistake. And as soon as it happened, I recognized what happened. I said, oh shit, you just did that. Trade activates very nicely. Has a pretty strong close towards the lows. And then it starts to bounce a little bit. And I'm going to zoom in. This is the 17th on the 7 o'clock hour California time. And I want to zoom into a 5-minute time frame to that period there. Here's the 17th. There's the break. So here we are. We're talking, this is the 650, 655. So let's zoom into this. Okay, we are now in 650, 2 more candles. Okay. So there we go. This is now 7 o'clock. This is where we are. So the trade closes nice in profit. It pretty much opens and just continues. It breaks the level and just starts to sell off right off the bat. Then pauses right around 107.30. And then this is what it does as I'm watching it. It hits this level, and then it starts to bounce a little bit. And I said, well, I have a couple options at this point. I'm in at 107.42. We're about an hour and a half from the London close, and it's now bounced for 4 straight candles. It did bounce back to a level, which was not too surprising. I had already moved my stop to trim off the risk to virtually nothing. So I said, okay, well, I have a choice now. Do I want to stay in this trade and possibly, get kicked out for break even at small loss? Or do I want to just get out and say, hey, I'm done for the weekend, close up shop, and that's it? Here's where the mistake was made. I was watching 2 charts at the same time. I was watching both the 1 hour and the 5-minute at that point in time. And the system itself was based on the 1 hour time frame. The thing is, I ended up making my decision off of the 5-minute time frame, saying, you know what, it's now bounced. We had a decent rejection candle here, buying, rejection, bought up, and strong buying, closes towards the high, and then starts to break this here. And I said, you know what, I'm just going to close it. This is where I made the mistake. The system's based on the 1 hour time frame. So if it's based on the 1 hour time frame, the minimum I should be doing is making my decision on the 1 hour candle. Why? Because on the 1 hour time frame, the system processes information based on how the 1 hour candles close. Open, high, low, and everything like that. So I should at least minimally wait for another 1 hour close before I make my decision. Then that will at least be calibrated towards the system that I'm using there. And instead, I made a look at the 5-minute and made my decision off the 5-minute without even letting the full 1 hour candle close. Well, let me zoom back and show you how it ended up playing out. Remember, my target was 106.96. I got in at 42. I originally had a, roughly 20 pip stop. And let me show you where I'm at. Zooming forward, 16th, 17th. So here's where I'm at. This is a candle close right here. Good candle close. But in the middle of that candle, it comes down and bounces back up. And I end up closing it instead of letting the next candle close. And look what happened. The next candle, if I'd waited till that candle had closed, very strong close towards the lows means no selling. That means the sellers aren't taking any profit. And I would have reached my target. And instead, I ended up getting out too early because I was watching the wrong time frame. and I wasn't taking into perspective, hey, this system is based on the 1 hour time frame. If I'm going to get out, I should be looking for a signal on a 1 minute time frame or a 1 hour time frame, not on something like a 5 minute. Because the 5 minute is going to show signals that are relative to the 5 minute, not to the 1 hour, therefore not relevant to the system. Sometimes it can give you a little bit of an early trigger, but sometimes it can get you out way too early. And as soon as it happened, I recognized what had happened. I had been trading, the only trades I'd made that day, I didn't have any other systems activate. The only trades I had made were off the 3 minute and 5 minute time frame. So my mind was kind of in the timing of an analysis of getting in and out of positions based on the 3 minute time frame. When I switched to the 1 hour, I had failed to switch my mindset to think like I'm trading a 1 hour system. If I was able to make that switch, then I would have immediately recognized, hey, you need to wait for the 1 hour candle. This system's based on that. That's the lens that views the market. So at least relate to the system as is. Don't relate it and try and relate it to something that it isn't. And as soon as it happened, I immediately recognized the mistake, wrote it down in my journal. I said, I'm going to want to talk about this one in the class. Because this is a mistake that can happen when you're trading on multiple time frames. You know, especially if you have been focused on one particular time frame for most of that day, your mindset will think like that. It will get stuck in that kind of mode of thinking. And it's important that as soon as you're done with that, you recognize, hey, this is the system I'm trading now. It looks at the market through this lens. I need to adjust my thinking to think, hey, it's a 1 hour time frame, very different than a 5. You need to be a little bit more patient, and I need to at least let, hey, this candle close for me to make my decision. And so that was a trading mistake, and it ended up costing me an extra 34 pips. So we're talking the difference between walking away with 12 pips or an additional 34, which would have been 46 pips. And so instead of walking away with I could have gotten 3 more times the reward than I had taken out of the market because I wasn't adjusting my mindset in that moment. And so this is sometimes the danger of switching between time frames and not really understanding, hey, my system is on this time frame. I should really be paying attention to that particular lens of the market because that's the system and that's the time frame that I grab the signal. So make sure that I'm keeping it consistent. It's very hard to switch to all of a sudden a 5 minute or 1 minute and translate, hey, this is a reversal on a 1 minute, but a reversal on a 1 minute could be anywhere from 5 to 10 pips. I'm gunning for 50, roughly 50 pips on this thing. So with that being said, I need to understand that what may seem like a reversal on one time frame is not on another. And so does that all make sense? Has anybody ever been caught in that trap before? Yes, no? And it's something, it's something that you have to watch and be careful for. And instead of really just relating to it as is, I was relating to it as something it wasn't. Chano says, no, never made that mistake. You've almost convinced me. So let's get into a couple questions here. And then I want to take a look at gold that I had made on 3 minute time frame. There are 2 trades I made on it, a long and a short. And then I want to talk about a sterling dollar trade if there's enough time. Harley says, but you can still glance at the 5 minute without any harm, right? You can if, A, you're able to make sure you switch the mindset, and B, understand what was the reason I took this system in this trade. I took it because I was getting an activation on the 1 hour time frame. So the real question is that why are you looking at the 5 minute? I had forgot to take my 5 minute chart off and just look at the 1 hour time frame. So it's not that it won't cause you harm. It's just that you have to be very careful to monitor yourself and make sure you don't fall into that trap. So hopefully that answers your question. Now, Dry Desert says profit taking equals a long wick. It depends. Profit taking could be a rejection, meaning that there was sellers in the market, but buyers had, after the currency or instrument had got undervalued, the buyers said, hey, this is way too cheap for it. This is way too fast to sell off. We need to, we're going to buy this. And so it could be a rejection, depending on the size of the body, depending upon the size of the candle as a whole, and depending upon the size of the rejection would generally determine. Profit taking generally doesn't create a really, really long wick unless it's an incredibly sharp trend to begin with. Profit taking tends to have kind of a decent sized wick, and then the candles that follow it up are kind of a mixed bag of balloon red candles, and they tend to be small. Why is that? That's because of the nature of order flow and how orders actually create activity in the market. When stops are triggered as a whole, if the majority of orders that are being triggered on a break or up or down are stops, it tends to create a more violent move. And the part of that reason is because it creates what is called a positive feedback model in terms of order flow. When your stops get triggered, there's a good chance you're sitting there going, shit, okay, that was serious. Do I need to consider the other side of the market? Maybe you get back in to help fuel it. But if a bunch of limit orders were hit to where people took profit, chances are they're not going to get back into the market right away because they're sitting there going, hey, I just made a nice little profits there. I want to make sure the next trade I made is smart because I've been buffing up my account now. So the nature of the psychology of orders tends to be that stops will create what is called a positive feedback loop, meaning that they tend to trigger a more violent response from traders. Even if you weren't stopped out, maybe you saw that a bunch of stops were triggered on the break, so now you're thinking about, hey, I want to get in the move on that, stop hunter or the trap that happened there or whatever. But if a bunch of profit was being taken, chances are not too many people are going to be entering in on that type of, hey, we just took, profit. So the people that are already in the market tend not to get right back in. And so that creates what's called a negative feedback loop, which means less trading and less orders tend to get activated from that. So profit taking tends not to be really long wicks. It can be if it happens at at a certain point of exhaustion, kind of a climax, either, a really exhaustive bar up or down at the end of a trend. That's possible. But generally profit taking tends to be more timid. Hopefully that explains it there. Jez says, if one enter on the 1 hour, some say can go to the time frame lower and trail ones trade with that. Would that be an okay thing to do? It can be. It just depends on the nature of the system. I had a system that is specifically tailored to the 1 hour time frame in catching momentum and volatility moves on that 1 hour time frame. And it had done a really good job at catching all these little swings over here. It caught the buy up, not at the bottom, but it caught a good portion of it. It caught a good 60% of the move. It caught 60% of the down move. It didn't get in this here, didn't get in this here, and then it caught about 75% of that one up. So, hey, with that being said, this system is designed to catch momentum and volatility trends type moves on the 1 hour time frame. Now, in terms of, hey, I entered it on the 1 hour time frame because I caught a price action setup. Yeah, you can trail it, but I would make that a very systematic method in the sense of, hey, I'm using this indicator and I'm trailing X pips behind it, or maybe the parabolic SAR, or, I would make sure that that trail is a fixed methodology, because if you just create some sort of arbitrary trail for that time, there's no way you're going to know whether that's an effective trail or not. And there's no way you're going to know if it's an effective trail for using triggers on the 1 hour time frame. So it's not a question of whether it's an okay thing or not okay thing to do. It's a question of how do you apply it. Hopefully answers your question. PLIU says, so we should make entry exit decisions based on the same time frame and not on a lower time frame as some people teach. I generally recommend that because, again, you start zooming into a lower time frame, maybe you see a bounce on a 1 hour time frame, your natural tendency is to be like, oh, that is a reversal signal. Well, yeah, maybe it is on the 5-minute time frame, but bounces on 5-minute time frames don't necessarily eclipse, several hours of selling. They can, but they have to be really extreme. And so if the lens and the reason that you bought or sold a particular instrument is on a particular time frame, I tend to recommend saying, hey, this is why I'm getting in the trade. This is why I'm getting out. Based on the same parameters and the same lens that you're seeing the market to enter the trade, generally I recommend that should be the reason you exit the trade. So hopefully that answers your question. Unless you can get really, really good at spotting very large reversals on smaller time frames, then I would recommend that methodology. But again, very rarely do all the reversal signals that come up on, say, a 5-minute time frame equate to reversals that take out 2 to 3 hours of selling. Does that make sense? Okay, cool. Aroma says yes. Not sure if Patricia did, so. Echo says that's an illusion. I'm not sure what you're talking about there. Fernanda says that's the main reason I am choosing not to look at the very small time frames, micromanaging. Absolutely. It's a very common thing. And especially if you have, you're still developing, because if you're still developing, you're still in the learning process, and you don't have hundreds and hundreds of trades, the tendency will be to have not necessarily as much confidence in your ability to really stay in a trade, hold trades for longer periods of time, really call tops and bottoms really well. And so since, you still don't have a lot of experience with that, then your tendency will be to micromanage, especially if you have that little window open that shows your profit and loss in real time. The more times you stare at that, the greater the probability is you will micromanage your trade. Also, the greater probability is every time you look at your account balance, once you've activated a trade, there is a direct correlation between the more times you look at that account balance for that particular trade, or, the P&L in real time. The more times you look at it, the greater probability you will make your trade based on money, profits, and loss than you will make a trade based on your system. If you think about it, where's your focus when you're looking at the P&L in that moment? It's focused on profits and loss. It's not focused on, hey, I made a trading decision based on this formation on the chart, so this is why I'm getting out. The more times you look at that, it starts to orient your thinking towards, hey, okay, maybe I don't want to lose this much, or maybe I only want to make this much, or, even though I had, 30 pips stop, maybe I should get out at plus 15. So every time you start to look at that, and you keep looking at that, that will increase the probabilities that that's how you're going to make your trading decision, which is the worst thing you could be doing. So if you have that habit, my recommendation is close that thing down or shut it. I tend to just shut it anyways. Hey, why even bother opening Pandora's box? Why not keep my mind focused on what it should be, which is the market and the price action and my system, and not on the P&L of that moment. When I do focus on the P&L, I will notice that I tend to get out of positions earlier, and I tend not to let my trades go full runners, and they end up hitting the runner, the full target anyways. And then I'm kicking myself in the ass saying, man, instead of being up 2% today, I could have been up 5% today, or whatever. So, and I'm sure you've all probably had that experience. I haven't met anybody who hasn't, cut their runners short. I have not met one person today that hasn't fallen into that trap. And so that's something to keep an eye on. Okay. Let's see here. Chris, can you tell us what is, by your experience, a stronger support and resistance level? Is it an EMA? Is it a pivot point level? This is a great question. It's a very excellent question, Solator. So I look at support and resistance as two kinds. There are static support and resistance levels, which would be prior highs and lows, say in a range. Like these would be static. They're static because they're based upon prior price action, how price responded to it, but you can't change how the price reacted in the past. There's nothing you can do about that. So these little horizontal levels are static. Other examples of static support and resistance levels would be pivot points. Your pivot points are the same pivot points for 24 hours. If you were to draw a Fibonacci level based on a high and a low, that will be static. Those Fibonacci levels aren't adjusting in real time. So those are static levels of support and resistance. There is also dynamic or evolving. I've talked about this for years now, which is a dynamic or evolving support and resistance would be a type of moving average, maybe a 20 EMA, whatever it is, your EMA of choice is. And so that will be what is called evolving or dynamic. Great case in point of how it works out. Market starts to break down, pull back to 20 EMA, sellers come in, pull back to 20 EMA, rejects of it, pull back to 20 EMA, rejects off of it, breaks above it, possible reversal of trend, traps traders, and it sells off again here. So that would be an example of an evolving support and resistance. It's not one fixed line in the sand. Now, is either one of them, those pivot points, Fibonacci, support and resistance levels, is any one of them better than the other? The answer is no. It depends in context. In an evolving directional market, the evolving support and resistance will tend to be stronger than fixed, because if it's fixed, for example, take a trend on the 4-hour time frame for, say, dollar yen, well, yeah, there's a level, maybe want to watch out for here, and that's fine. But once you break past that, that level no longer really means anything. It may in the distant future, but this thing is continually making higher and higher ground. So what becomes the more important support and resistance level? It becomes, in this case, the evolving support. Will the market treat it as support? Bam, bam, pulls back, bam, again. That will be it. There will be some support and resistance levels that will be critical inside. That may be a longer term support and resistance. So we have to zoom back out and look for a larger level. But in a trending environment, only the most extreme support and resistance levels will have a lot of potency. Why? Because in a trending market, you're constantly clearing resistance, new highs, new highs, new highs. So hopefully that answers your question. In a much more range-bound environment where there's less volume and volatility, then pivot points and static support and resistance levels will tend to have more potency. Does that make sense, Solator? It's an excellent question. Hopefully it does. Okay. 1.4718. Hi, Chris. A bit unassociated. It's a bit unassociated, then why are you asking? In your experience under normal market conditions, typically what size orders in the FX major pairs become a challenge to fill? The one lot is 100K, so we're talking standard lots here, nominal. So 100 lots, 200 lots, 500 lots. This is an excellent question. That would depend on the particular pair that you're trading. So trading 100 or 200 or 500 lots, it would depend on a combination of your broker. It would also depend on the combination, does your broker become a counterparty after a certain size volume? If so, then that's going to be an issue. It would depend upon the active volume and volatility in the market. So it really depends upon broker. Do they become counterparty? What pair you're trading? On Euro US dollar, trading 100, 200 lots tends not to be that much of an issue. And again, if you're with one of the bigger brokers, it's not going to be that much of an issue. That can be done, especially if you're doing it during the London session. You start doing that in that space between New York close and, say, Kiwi Open or Aussie Open, that's going to be a much different order to fill, and it's going to be a lot more difficult. So, I actually did this once. I was actually playing with, it was a long time ago. It was at GFT. It was about 10 years ago. And I took a 10 standard lot position on dollar Thai baht. I had a pretty good insight as to what was going on in Thailand. I had some friend who was actually on the ground in Thailand there giving me some insight as to what was going on. It was a great technical setup. But I took the trade during non-liquid Thai baht hours, which means non-Asian session. And as soon as I hit the trade, I immediately could tell the dealer wasn't liking it because he was like, what the F? Why is the trade coming in now on dollar Thai baht? Normally you don't see these until the Asian session. And it was still New York session. And it literally took about 15 seconds to fill. And it was pretty entertaining because, I could just tell what was happening. The messages I was getting were, it was more of like along the lines, hey, that dealer's having a hard time filling it. And he was just kind of shocked that a dollar Thai baht order came in at that time. Keep in mind, 10 years ago, there was very low volume on dollar Thai baht, especially off hours. So, in answer to your question, most brokers don't have a problem with that. Also, you got to consider if you're trading 100, 200, 500 lot standard, then you're put into a different server with your broker. You're put into an institutional server because most retail traders don't make 100 or 200 or 500 standard lot trades. And if you're trading that much, you probably already have an institutional size account of say 250,000 or more. So once you get to that level, you're automatically put on a platform with better liquidity. You're put on, you get better fills. They've probably told you whether they're going to be your counterparty after X amount of lots, X amount of volume. And most of them don't have a problem at that point. Once you're on the institutional server, they're used to dealing with that on that particular server, filling those kinds of trades. So, you would have to be doing an odd liquidity pair at an odd time at 500 lots to really, cause a problem with your broker. But also smaller brokers will have a hard time with it, especially if they're having to be your counterparty. So hopefully answers your question. Okay, Michael says, all these 3-minute trades are making me very nostalgic for the good old days when I looked at 4-hour and daily charts. It's like we have moved from the laid-back beach in Thailand to the hustle and bustle of Beijing or rush hour, very twitchy. But never mind, it's all good, and I'm sure the skills are transferable. Mike, I'm going to be showing you, the next trade I'm showing you is sterling dollar in the 4-hour time frame. So I'm not like leaving you out in the dust or anything like that. I'm trying to show a healthy balance between the two. The bottom line is the skill sets are mostly the same. 90 to 95% of the skill sets you have learned on trading the 4-hour and daily charts are going to be the same on the 3-minute time frame. But to be honest, if you have no interest in that, that's okay. Don't bother trading the 3 minutes, but there's still something to be learned from watching how I'm interpreting the price action on the 3-minute time frame, because 90% of that skill and that ability to read price action is going to be applicable to the 4-hour time frame. So hopefully that makes sense. It's still the same skill set. So, but I apologize for bringing you to the twitching level of things. Last few questions here. Is intraday smaller time frame entries are the best trades when we're in a trending or a sideways market? Not necessarily. Not necessarily at all. Sometimes in a trending market, my best signal will be on a 1-hour or 4-hour time frame. I saw an example of somebody, there was a trade I had taken, and somebody had taken the same trade or taken the same type of trending move on the 5-minute time frame, but they made 5 trades in that whole process, and they were bragging about, hey, I'll bet you can't do this on the 4-hour time frame. And I was just sitting there laughing because I had caught the pullback before the whole trend even started on a 4-hour time frame and just made one trade all the way down. And so, I made roughly about 80 to 90 pips on one trade and paid the spread one time. So I paid a 1 pip spread to make 90 pips, and they paid 5 pips to make roughly 80 pips. So who wins? It really just depends on the environment, depends upon the nature of the setup. There's no one lens that's better than the other. Price is price, charts are charts. It's just a different way to look at the same information. The price action over the last 24 hours is the same price action on the same pair. It's just looking at it through a different lens on, say, a 3-minute as opposed to a 1 hour, 4 hour. Sometimes the setups will be better on the 1 hour and 4 hour. Sometimes maybe not. It just depends on the nature of how that plays out in real time. Hopefully answer your question. TLIU says, what about trading on daily time frames but looking for optimal entry exit points on the 4 hour or 1 hour? Again, it's the same thing. You could do it. You just have to make sure you are keeping things in context. So it can be done. Hopefully answers your question, though. SLD, so for intraday, what is the best time frame? The best time frame is whatever one you like the most and can trade the most consistently. There is no one best time frame. It's the most ridiculous argument I've ever heard out there, you know. So the best time frame is the one that you can read the price action the best, trade the most consistently, and execute your orders to where trading in that time frame is not a disadvantage. You're not losing from trading on that. So for intraday, I prefer the 3 to 5 minute. For the rest of the time frames, 1 hour, 4s, and dailies are fantastic. Happy Josh says, what do you mean by longer time frames? It's that upper region, 1 hour, 4 hours, and daily. So I consider that to be the medium to upper region. The lower region to me is the 3 to 5 minutes. You know, those are my favorite choices on that. PLI says, so you recommend focus on just one time frame and not going into the lower time frame to manage the trade? I think I've answered this question before, so let me know if I haven't. Okay, last few comments, and I want to get in the sterling dollar on, while I'm at it, I just pulled it up, on the 4 hour time frame. I'm going to show you a trade that I recently took on it, and did quite well on it. It was a nice quick trade, literally had less than a 20 pip stop, worked out really well. Let's see here. Frank says, what do you think of Thailand if the world debit crisis gets worse? FX investments. Do you mean investing in the Thai baht as a whole? Do you mean investing in Thailand as a whole? This is more of like an economic fundamental question, but as a whole, everything I see points to the money shifting to Asia. Everything. You know, by 2030, the top 8 out of the top 10 countries by trade will all be in the U.S. or will all be in Asia. U.S. will no longer be number 1; it will be 4th or 5th. Germany will move to 7th. China will be number 1. Thailand comes in there, I think, at about 8th, roughly. So, you know, with 8 out of the 10 being in Asia, that tells you that there's going to be a lot more money to be made there than there is where the money's leaving. The thing is that you want to be investing in areas where the money's going to, not where the money is leaving. That's the worst type of place to be investing into. And the bottom line is that money's leaving the U.S. and money's leaving Europe, and it's all heading to Asia. You know, it's undeniable. It's undeniable. Which country is able to make the most financial investments in resources and companies around the world? Asian countries right now. You know, not the U.S. The U.S. is just barely holding on. Europe's barely holding on. They're just trying to not blow up. And so, you know, who's gaining ground here? Also, politically and historically, for the last 4,000 years, the center of power has always left regions where the money's leaving and always went to the regions where the money's going. That's always been the center of power. It has been repeating it for 4,000 years. I don't see that changing anytime soon. So hopefully answers your question. Solitar says, can you please recommend us the best book to learn candle patterns? If you're talking about candlesticks, I don't trade candlesticks. But if you want to know a really good book to learning candle patterns, wait for my book, Trading Price Action, which I've been working very heavily on. And I expect to be done inside the next 3 months. That I'm going to be talking about all kinds of things. You know, I'm going to be talking about being able to read price action in real time, how to interpret order flow, how to understand candles. I talk about 2 1-bar candle patterns. I talk about how to trade pullbacks, how to trade breakouts from a price action perspective. I've researched at this point up to date over 1,000 different inside bars. And I'm going to be releasing an entire litany of information on inside bars after researching 1,000 inside bars. I'm at about 500 pin bars. I'm going to be, once I get it to 1,000, and that's on multiple time frames. What I do is I look at pin bars on multiple time frames. I take notes as I see patterns, and then those notes are going to be put into my book. So, I've never seen anybody that took one pattern and then looked at 1,000 of them manually, wrote down all the patterns that they thought, all the insights, and then put that into a book. And so that would be my recommendation. So hopefully I answer your question. Okay, last few, and then I want to get into the 4-hour trade on sterling dollar. Carlos says, after executing a trade on the 1-hour and 4-hour chart, and then looking at the 5 or 15-minute chart, would you determine whether it is a pullback or reversal? Would you determine whether it is a pullback or reversal? Number of pips, percentage from the entry. Well, first thing is that generally reversal price action triggers on a 4-hour time frame or a 1-hour time frame tend to look somewhat similar on a smaller time frame. So a pin bar tends to be a really good reversal signal if it's taken in the right context. And that's on a 4-hour, a 1-hour, or even a 3 or 5 minute chart. And so, but the thing about it is that a pin bar on a 4-hour time frame tends to have a much different microstructure on, say, a 1-hour or 5-minute time frame. So you have to understand, hey, you have to be able to graft whatever it is that reversal formation you're seeing on the 3 and 5 minute time frame. Would that translate into reversal on a 1-hour or 4-hour time frame? And so, this is something that I actually cover in my book. Hey, reversals on a 4-hour time frame tend to look like this on the 1-hour time frame, or they'll look like this on a 3-minute time frame. And I even break down those patterns and break down the structure and explain why they look like this on one time frame and different on another. So there tends to be correlate micro patterns that are part of reversal patterns that are part of a macro part of that. So hopefully answers your question. But I wouldn't look at number of pips or percentage from your entry, because that can be relative. Volatility could be small on that day, so number of pips would be relative. Volatility could be huge on that day, so number of pips would be relative. So I would definitely not use number of pips or percentage, because that's relative to based on the price action for that day. If the volatility is really high, I'm looking for larger targets. So hopefully I answered your question. Prancer says, how much of your account do you risk per trade? Rarely ever more than 2%. Rarely ever more. Max would be 5, and I better be damn sure on that one. But rarely ever more. It also depends on how much I've gained on that day. If I've gained, 8% on the day, I might be okay with risking 5, because if I get stopped out, I'll still be up plus 3. So it really depends on how that day has been unfolding. But if it's the first trade of the day, I will never risk 5% right off the bat. I just won't do it. So hopefully answers your question. Did I say Asia 2013 or 2030? 2030. RSM 198 says, if past statistics on IB and pin bars could make a trader profitable, then the banks and institutions would have got programmers to make the necessary software to milk the market. The truth is that past statistics are just statistics. I'm going to disagree with you, RSM. First of all, if you look at the largest increase in trading, what is the largest increase in trading right now? It's algorithmic. What are those algorithms using? Those algorithms are using statistics. They're using pattern. They're not using randomness. They're using pattern. They're using things that have repeated themselves. All systems are based upon variables that repeat themselves. And if your quantitative data or your statistical data is robust enough and has a large enough period of time behind a large enough data set, and you filtered out, standard deviations and variables like that, well, then that is very useful. I'm going to completely disagree with that, because I have an algorithm that tells me, hey, you should expect to be about 70% accurate on this. And for the last 7.5 years, 8 years, it's been 76% accurate consistently year in, year out. How does that happen? It's not a one-year anomaly. There's no way something like that could happen over 8 years. It would have filtered itself out if it wasn't statistically accurate. It would have blown itself up. but it's consistent year in, year out. I have done statistics for 10 years, over 10 years of data on inside bars and pin bars. And go figure, over several years' time, those things played itself out. I did the quantitative analysis on multiple servers. Then we would test it. We would back test that on multiple servers. And go figure, they would statistically play out close to what the algorithm pulled out of the market, give or take 1 to 3%. We would test it in a separate program called MATLAB. And then we'd say, hey, this thing pulls in at 63% accurate. And then when we back test it on MT4 with the same price feed, go figure it clocks in at 61 or 64 or 65%, give or take for the tick modeling there. So I'm going to disagree with you. You got to remember, banks and institutions are doing that day in, day out. What's the biggest increase in trading? It's algorithmic and systematic trading. And what are they doing? They're using algorithms and statistics. So hopefully answers your question. Many ways to skin a cat results in multiple damage. Correctly informing the algorithms is high-frequency trading, not just high-frequency trading. High-frequency trading in the FX market right now, as according to the Bank of International Settlement study in 2011, in the summer of 2011, only 25% of that was high-frequency trading. But banks as a whole, generally as a whole, 60 to 70+% of them are doing algorithmic trading. Algorithmic trading is not limited to high-frequency trading. Why would algorithmic trading be limited to high-frequency trading? If you really understand what quant traders are doing, quant trading as a whole is you have a quantitative analyst who's running his quantitative algorithm, and all of a sudden he gets a signal, he sends that to the trader. He sends it, okay, here, you got a signal at this one here, buy here, sell here, and that's it. HFT doesn't do that. HFT is automated through the program itself because there isn't enough time to send that to another to trade that. So I know entire quant trading desks where they just have the quant traders just actually calculating signals and then sending that to the trader, and then the traders are executing. But they don't have the quant trader running the calculations and making the trading because they're too busy running calculations. They don't have time to execute those orders. So that's generally how quant trading happens. And it's not HFT. Only 25% of the volume right now on a daily basis is HFT, but yet 60 to 70% of the banks are trading algorithmically. The pricing model. This is why I find it funny that people are always worried about the broker taking them out. The pricing models by the interbank market, the top 5 to 7 banks, plus EBS and Reuters, is all algorithms doing the pricing for them. It's much easier. It costs them less to have computers manage the pricing models than traders. There's less human error. There's less error because there aren't humans making errors. They can execute faster. So most dealing desks all of a sudden got shrunk from, say, 20 to 4 or 20 to 2 or 10 to 1. When I was working at FXCM back in 2006, our dealing desk at the highest points in time could consist of 20 people, maybe even more. It shrunk by 4 times that. The one in FXCM Hong Kong, when I was there during the highest volume motions of the day, there was 3 dealers and 3 guys in there, and that was it. And yet they had 12 computers. That's because they switched to algorithmic pricing. So hopefully answer your questions, but it's not entirely accurate. RSM algorithms on short-term trading, so it means time is of the essence, time in terms of split seconds. That's for HFT. That applies for HFT. So hopefully answers your question. All right, Jano says, what is the main purpose of your broker playing counterparty triggering stops? It's an old, well, okay. Here's the thing about it. If the broker has a dealing desk to where they are involved in the market, then it is to their advantage to some degree to trigger stops, to trade against their book. Most brokers have moved away from this. One, because if they have positions in the market, then they're exposed to risk. What happens if a larger party comes in and takes them out? You got to remember, your retail brokers are not the biggest players in the market. They're medium-sized fish in a very large ocean, full of sharks and whales and all kinds of bigger fish. And that means that even though they're predator to the fish smaller, they're prey to the ones above them. So anytime that broker is involved in the market, they are exposed to risk as a whole. But in terms of the broker being the counterparty, depends on how that broker runs their dealing operations. Most brokers, a lot of the brokers now are moving towards being ECN, pass-through execution, non-dealing desk. It's just a far better business model to be that, because all you have to do is just offset orders all day. You have no risk in the market, and you have a guaranteed money-making machine. All you're doing is collecting spread all day, hundreds of thousands of times. That's a cash cow. So you're going to do everything if you're smart, you're going to do everything you possibly can to not be in the market at all. Now, some brokers, depending on how their style is, will be your counterparty. I mentioned this in my last article. Deutsche Bank, DBFX, or Deutsche Bank as a whole, was the counterparty on any trade over 5 million. So that's why we never traded with them. As soon as we asked them right off the bat, hey, are you our counterparty at any point in terms of volume? And they said, yeah, 5 million. And then we said, ciao, we're not with you guys at all. We don't want anybody to be our counterparty. Ideally, your broker, if they're smart and they really like your system and they do take positions in the market, if you have a profitable system and you're trading considerable size and they do participate in the market, then oftentimes your broker will actually take positions with you. So they realize, hey, this guy's been trading with us for 2 years. They're accurate 60-70% of the time. They will put you into a certain client list of, hey, these people tend to make money. If we're going to trade against people, we don't want to trade against them. So it just depends on the broker. Not all brokers are doing it. It's getting less and less. All right. Okay. So I'd be willing to take another question. I'd be happy to finish in 2 minutes. I'll be willing to take a couple more questions. Other than that, I'll need to wrap up. All right. Well, it seems like that's going to be it. Well, I do have 2 quick things I want to share with you. Check out my most recent article. It's actually a quiz of sorts. It's a challenge to see how well you can recognize patterns in price action. And this is something that I actually went through in a test myself. And then, how fast I was able to analyze the price action. So take a look at it. Leave me your comments as to what you recognize, what patterns you recognize, what your strategy is. And then we'll go for there. And also, I'm not sure if you heard, but we're celebrating our 5-year anniversary. Today's the last day of the competition. So if you want to participate and get some great prizes, feel free to check us out on that page. Other than that, I bid you all adieu. Please stay on for the next speaker. It was great having you guys here. Great going over this stuff. Next week, we're going to cover some more 4-hour charts because Michael was sad. And then we'll do the 4 hours first, and then we'll do the 3 minutes after. So, and yes, if the voting competition, if you guys like what I do, you like this style of teaching, it all makes sense, and you find value in it, make sure to vote in the contest. I think I'm in 2 categories for best educational content, or there's 2 categories, and so if you can vote for me there, much appreciated. Stay on for the next speaker. Have a great week, and I'll see you guys next time. Take care, everyone.